January 22, 2026. A routine blockchain transaction lights up crypto tracking screens across Wall Street. $430 million in Bitcoin moves from cold storage to Coinbase Prime. Most people scroll past it. But in the mahogany boardrooms of America's oldest banks, this number triggers something close to terror. Because this isn't a transaction, it's a symptom. The symptom of a $70 billion proof that just shattered a 200-year monopoly.
We've been told that banks are safe, that deposits are protected, that the financial system is stable and regulated and too big to fail. But here's what they're not telling you. The biggest banks in America are facing an extinction-level threat. And it's not coming from a crash or a crisis. It's coming from something far more dangerous. A better product.
For 2 centuries, commercial banks held an absolute monopoly on one thing: your cash. If you wanted to store money, you put it in a bank. If you wanted to move money, you used a bank. If you wanted to earn interest, you needed a bank. There was no alternative, no competition, no choice. The banking system wasn't just powerful, it was inevitable. But on January 10, 2024, that monopoly cracked. The Securities and Exchange Commission approved 11 spot Bitcoin exchange-traded funds. And the largest fund, BlackRock's iShares Bitcoin Trust, just crossed $70 billion in assets, $70 billion in 2 years. That's not just fast growth, that's proof of concept. Proof that institutional money, the pension funds and endowments and wealth managers who control tens of trillions, they want crypto exposure. They trust it, they're allocating to it. And once you prove that institutional capital will flow into digital assets through regulated vehicles, the next question becomes obvious. Why stop at Bitcoin? Why not stablecoins earning 5% when bank accounts pay 0.1? Why not tokenize treasury bills settling instantly instead of 2-day delays? Why keep $6 trillion trapped in a system designed in 1863 when blockchain offers something objectively superior? Brian Moynihan, the CEO of Bank of America, asked himself that question. And on January 15, 2026, he gave a speech at a private banking conference. He told a room full of institutional investors that $6 trillion could leave the United States banking system within 36 months. 6 trillion. That's 30% of all commercial bank deposits in America. Gone. Not to other banks, not to foreign institutions, to stable coins and tokenized assets that didn't exist as serious threats 5 years ago. The speech was supposed to stay private. Someone leaked it. Within hours, Bank of America stock dropped 3.2%. The market started pricing in the threat as real, as material, as happening right now. This is the story of how BlackRock's $70 billion Bitcoin ETF became the catalyst for the biggest structural shift in banking since 2008. How a single fund proved that trillions in institutional capital would abandon traditional banks if given a better alternative. And how that proof of concept triggered a cascade that could reshape American finance within 3 years. This isn't speculation. This isn't fear-mongering. This is mathematical inevitability playing out in real time. And most people have no idea it's happening. Let's go back to the peak, back when American banking seemed invincible and eternal. The year 2007. Commercial banks held $13 trillion in deposits, branches on every corner. Marble lobbies and vault doors 3 feet thick. The branding was deliberate. Strength, permanence, security. Banks didn't just hold your money. They represented stability itself. The Federal Deposit Insurance Corporation guaranteed accounts up to $250,000. The Federal Reserve stood behind the system with unlimited liquidity. Too big to fail wasn't just a slogan. It was policy. It was reality. If you had money in America, you put it in a bank. There was no other option that made sense. The revenue model was brilliantly simple. Banks paid you almost nothing on deposits, maybe 1 or 2% if you were lucky. Then they lent that money out at 5 to 8% on mortgages, 10 to 20% on credit cards. The spread was pure profit, and because of fractional reserve banking, they could lend out $9 for every $1 they held. It was a money printing machine backed by government guarantees. The system worked because customers had no alternatives. You needed a bank to cash checks, to pay bills, to get a mortgage, to store money safely. The banks had total control, total pricing power. They could pay zero on deposits and charge whatever they wanted on loans. Customers accepted it because there was no choice. But beneath the surface, the foundation was rotting. The 2008 financial crisis exposed the first cracks. Lehman Brothers collapsed. Bear Stearns vanished. Washington Mutual became the largest bank failure in American history. The Federal Reserve had to inject $700 billion to prevent total systemic collapse. Suddenly, the too big to fail guarantee looked expensive, fragile, conditional. Customers started asking uncomfortable questions. If these banks are so safe, why did they need a government bailout? If deposits are guaranteed, who guarantees the guarantor? Trust eroded. Not completely, not immediately, but slowly and steadily. People kept their money in banks because there still wasn't an alternative. The monopoly held. For now. Then came the addiction. 15 years of zero interest rate policy following the crisis. The Federal Reserve dropped rates to nearly zero and kept them there until 2022. This destroyed the traditional banking business model. Banks couldn't charge high rates on loans when the Fed funds rate was zero. Mortgages dropped to 3%. Corporate loans to 4%. The spread compressed. Profitability fell. Banks responded by paying even less on deposits. Savings accounts went from 1% to 0.1%. Checking accounts paid nothing. The banks were squeezing customers to maintain profit margins. And customers tolerated it because they were trapped. Where else could you go? But the zero-rate policy created something else. A massive hunt for yield across the entire financial system. Pension funds needed 7% returns to meet obligations. They couldn't get it from bonds paying 2%. Endowments needed returns to fund operations. They couldn't get it from savings accounts paying zero. Institutional investors started looking for alternatives. Private equity, real estate, commodities, high-yield debt. Anything that generated returns in a zero-rate world. And increasingly, they looked at Bitcoin, not as a currency, not as a payment system, but as an uncorrelated asset with potential for appreciation. Something that moved independently from stocks and bonds. Something that might provide returns when everything else was stuck at zero. But there was a problem. Institutional investors couldn't buy Bitcoin directly. Regulatory frameworks prevented pension funds from holding crypto on balance sheets. Custody solutions were immature and risky. Boards of directors wouldn't approve it. Compliance departments blocked it. The demand existed. The infrastructure didn't. That's where the antagonist enters. Not a person. An institution, BlackRock, the largest asset manager in human history. $10 trillion under management, more than the GDP of every country except America and China. When BlackRock moves, markets follow. When BlackRock files an application, regulators pay attention. And on June 15, 2023, BlackRock filed for a spot Bitcoin ETF. Other companies had tried for over a decade. The Winklevoss twins filed in 2013, rejected. They tried again in 2017, rejected. VanEck tried in 2018, rejected. The SEC's official reason was always investor protection. The real reason was regulatory resistance to legitimizing an asset class that threatened traditional finance. But BlackRock is different. BlackRock doesn't file applications it expects to lose. BlackRock had something the others didn't. Relationships, credibility, scale. A reputation built over 35 years. When Larry Fink, BlackRock's CEO, publicly called Bitcoin digital gold in multiple interviews, the market listened. When BlackRock designed custody solutions with Coinbase and surveillance sharing agreements with regulators, the SEC paid attention. This wasn't a crypto company asking for approval. This was Wall Street asking. That changed everything. On January 10, 2024, the SEC approved 11 spot Bitcoin ETFs simultaneously. Fidelity, Invesco, Franklin Templeton, VanEck, Valkyrie. All got approval. But everyone knew the one that mattered was BlackRock's iShares Bitcoin Trust, ticker symbol IBIT. The first day of trading, IBIT processed $627 million in volume in one day. By the end of the first week, $1 billion in assets. By the end of the first month, $10 billion. By the end of the first year, $55 billion. The growth curve was exponential, unprecedented, faster than any ETF launch in history, faster than the SPDR Gold Trust, faster than any equity fund. The market was screaming a message. Institutional demand for crypto exposure is massive and real. As of January 22, 2026, IBIT holds $70 billion in Bitcoin. That makes it the 19th largest ETF in America, ahead of funds that have existed for 20 years. A 2-year-old Bitcoin fund is in the top 20 out of thousands of ETFs. But the number doesn't tell the full story. Look at who's buying. According to SEC filings, over 700 institutional investors now hold IBIT. State pension funds, university endowments, insurance companies. These aren't speculators. These are fiduciaries managing police officer pensions and teacher retirement funds. Wisconsin's state pension holds $29 million. Michigan's holds $95 million. Arizona's public safety personnel system holds $19 million. Conservative institutions with strict fiduciary mandates are putting retirement money into Bitcoin through BlackRock. Why? Because the 60-40 portfolio died during zero-rate policy. For decades, the standard allocation was 60% stocks, 40% bonds. Bonds provided stability and income, but 15 years of near-zero rates destroyed that model. A 10-year treasury paying 2% when inflation runs at 3% means you lose purchasing power. Institutional investors needed alternatives. Real estate is illiquid. Private equity has long lockup periods. Commodities don't generate cash flow. Bitcoin offered something different, an uncorrelated asset with low correlation to stocks and bonds. From 2013 to 2023, Bitcoin's correlation to the S&P 500 was near zero. That's exactly what portfolio theory demands. An asset that moves independently provides diversification benefits. But institutions couldn't buy Bitcoin directly until BlackRock provided the vehicle. A regulated ETF they could purchase through existing brokerage accounts, familiar custody and settlement. No need to hire crypto specialists or build new infrastructure. BlackRock removed the friction. And once the friction was gone, the floodgates opened. In the first week of January 2026, IBIT saw $888 million in net inflows. 1 week. That's institutional money flooding in after New Year portfolio rebalancing. Fund managers making allocation decisions for the year ahead chose Bitcoin exposure at scale. The $70 billion isn't the end, it's the beginning. Because what BlackRock proved with Bitcoin, they're about to replicate with stablecoins. March 2024. BlackRock launched the BlackRock USD Institutional Digital Liquidity Fund. Ticker symbol BWIDL. A tokenized money market fund built on the Ethereum blockchain. Institutional investors buy tokens representing fund shares. The tokens are programmable and instantly transferable globally. The fund invests in cash, treasury bills, and repurchase agreements. It yields approximately 5% annually. And it settles instantly. Not 2 days, not next business day, instantly. As of January 2026, BWIDL holds over $700 million in assets, small by BlackRock standards, but operational, functional, proving the model works at institutional scale. This is the blueprint. Bitcoin ETF proves crypto demand. Tokenized fund proves blockchain infrastructure works. Stablecoin provides the on-ramp for trillions. According to multiple industry sources, BlackRock filed preliminary applications with the Office of the Comptroller of the Currency to operate a federally chartered stablecoin. BlackRock hasn't confirmed publicly. But sources familiar with the application process say it's real and progressing. Imagine a BlackRock-issued stablecoin launching in late 2026, fully backed by U.S. Treasury bills, yielding 4.5% distributed to holders. Available through every broker and wealth manager that already distributes BlackRock funds, which is basically everyone. Institutions trust BlackRock more than any crypto-native company. If BlackRock offers a stable coin with institutional-grade custody, regulatory compliance, and competitive yield, adoption will be massive and immediate. That's the master plan. Bitcoin ETF proves demand and generates $70 billion in assets. Tokenized funds prove blockchain works. Stablecoin provides the on-ramp for trillions. And once dollars enter the digital ecosystem earning yield and operating on blockchain rails, they don't flow back to traditional banks. They stay digital, moving instantly, operating globally. Outside the banking system entirely. This is why the $70 billion matters so profoundly. Not because $70 billion is transformative by itself, but because it's proof of concept, proof that institutional money will abandon traditional banks if given a better alternative. And now the infrastructure is being built systematically to capture the $6 trillion that Brian Moynihan sees leaving. Let's walk through the smoking gun moment. January 15, 2026. Brian Moynihan stands before a private banking conference in Florida. He's not known for hyperbole or panic. He's a measured, careful speaker, a lawyer by training. But on this day, he delivers a warning that should have made every headline in America. $6 trillion in deposits could migrate to stablecoins over the next 36 months. $6 trillion represents roughly 30% of all commercial bank deposits. Gone. He's not fear-mongering. He's stating mathematical reality based on yield differentials. If stablecoins pay 5% and banks pay 0.1%, customers will move money. Not all at once, not in a panic, but steadily and relentlessly. 3% in month 1, 5% in month 2, 10% in month 6. The exodus compounds. It accelerates. It becomes inevitable. The speech was supposed to remain confidential. Someone leaked it within hours. Financial media exploded. Bank of America stock fell 3.2% in 2 days. JP Morgan fell 2.8%, Wells Fargo 2.4%. Regional banks dropped even harder. The market started pricing in the stable coin threat as material and immediate. Not someday. Now. Analysts started modeling deposit flight scenarios. What happens if 5% leaves? What happens if 10% leaves? The numbers were terrifying. Banks operate on fractional reserve lending. When you deposit $1,000, they keep $100 in reserve and lend out $900. The system works because not everyone withdraws simultaneously. But what if that assumption breaks? March 2023, Silicon Valley Bank held $200 billion in deposits, most from technology companies and venture capital firms. Those deposits were invested in long-term treasury bonds purchased when rates were near zero. Then, the Federal Reserve raised rates from 0 to 5% in 18 months. Bond values crashed. SVB was sitting on $15 billion in unrealized losses. When depositors got nervous and started withdrawing, SVB had to sell bonds at huge losses. The losses destroyed the bank's capital base. Within 48 hours, Silicon Valley Bank went from solvent to bankrupt. $142 billion in withdrawal requests in a single day. The 16th largest bank in America collapsed in 2 days. That was one bank failing from panic. Now imagine that dynamic playing out across the entire system. Not from panic, from yield competition. The descent is already underway. January 2026. Commercial banks reported deposit declines in fourth quarter earnings calls. $212 billion in outflows in Q4 2025 alone. Where did it go? Some to money market funds, some to direct treasury purchases, and increasingly to stable coins. Not because customers are panicking, because they're calculating. 0.1% versus 5%. The math is undeniable, and as stable coins become available through mainstream channels, Fidelity and Schwab and Vanguard, the choice becomes obvious and accessible. No complicated crypto exchange accounts, no wallet setups. Just an option in cash management menus. Hold dollars at 0 or stable coins at 5. Everyone chooses 5. Banks are responding predictably. They're raising deposit rates to compete. Instead of 0.1%, they're now paying 1%, then 1.5%, then 2%. But this compresses net interest margins. If a bank pays 2% on deposits and earns 5% on loans, the spread is 3%. If they pay 3 to compete with stablecoins, spread drops to 2. Profitability falls 33%. Stock prices decline. Credit ratings face pressure. Some banks try a different strategy. They partner with crypto companies. JP Morgan announces integration with Circle to offer USDC through JP Morgan accounts. Bank of New York Mellon launches stablecoin custody for institutions. These banks position as infrastructure providers. If you can't beat the gold rush, sell shovels. Traditional banks are trapped by their own weight. High costs, legacy branches, massive payrolls, endless compliance. They can't raise yields without destroying profits. Stablecoin issuers don't have that problem. They're software companies, lean teams, minimal overhead, better unit economics in every direction. This isn't a scandal or a crisis. It's a liquidation sale caused by technology. Banks thought they were competing with other banks. They weren't. They were competing with code. In early 2026, the shift becomes visible. Circle's IPO lands. Strong debut. Media tone changes overnight. Crypto stops being framed as fringe and starts being treated as financial infrastructure. Fidelity launches a yield-bearing stablecoin. Billions flow in within weeks. Then Schwab. Then Vanguard. Then Merrill. Stablecoins aren't marketed as crypto anymore. They're marketed as enhanced cash management. Corporate treasuries move next. CFOs shift small percentages of idle cash. Same liquidity, same risk profile. Millions more in annual yield. Boards approve. Word spreads. By mid-year, stablecoin supply explodes and bank deposits quietly shrink. Not a panic, a pattern. By year-end, hundreds of billions have moved. Not because banks failed, but because better products won. The banking system doesn't disappear. It transforms, from gatekeepers to service providers, from monopolies to competitors. This is the moment money doesn't vanish. It migrates, slowly, mathematically, inevitably. The question is whether you understand it early enough to position accordingly. History is not decided by armies or politicians. It's decided by accountants, debt, and resources. The ledger always wins. And right now, the ledger is rewriting the future of American banking. Thanks for watching.